They are all hitting at once. That is the sentence you need to understand before Monday morning. Not one crisis, not two, all 9. The dealer lockdown, the auction failure, the stablecoin drain, the repo surge, the margin shock, the mortgage transmission, the credit repricing, the reserve burn, the derivative cascade. 9 invisible mechanisms operating independently for months. And now in the span of 2 weeks, they have begun to synchronize. This is not a coincidence. This is how complex systems fail. They do not collapse from a single blow. They fragment from 1,000 invisible cracks. And then, at a critical threshold, all the cracks connect. The structure does not bend. It shatters. In this final investigation, we are going to map the convergence. We are going to show you how 9 separate mechanisms have begun feeding each other in a cascade that no single institution can stop. We are going to explain why the Federal Reserve now faces an impossible choice between 2 forms of destruction. And we are going to give you the 3 signals that tell you the system has crossed the event horizon. This is not speculation. This is systems analysis. When you study how grids fail, how bridges collapse, how ecosystems die, you see the same pattern: convergence, amplification, collapse. We are watching it unfold in financial markets right now. Educational analysis only, not financial advice. For 4 decades, the global financial system was built on a principle that seemed unshakable: modularity. Each market operated in its own container. Stocks traded on exchanges with circuit breakers. Bonds cleared through primary dealers with Fed backstops. Repos ran through clearinghouses with collateral buffers. Commodities moved on futures platforms with margin controls. Derivatives settled through central counterparties with default funds. The design was intentional. If one module failed, the others would continue. If stocks crashed, bonds would rally as safe havens. If commodities spiked, central banks would tighten to cool demand. If banks faced runs, the Fed would open the discount window. Each crisis had a playbook. Each playbook assumed isolation. But isolation requires 2 conditions that no longer exist. Condition 1, spare capacity. In 2008, when the crisis hit, the Fed's balance sheet was $800 billion. They could print $4 trillion without breaking the dollar. Bank reserves sat at comfortable levels. Corporations held cash. Pension funds were flush. There was slack in the system. Fat to cut, assets to sell without crashing prices. Condition 2, sequential timing. The 2008 crisis took 18 months to unfold. Bear Stearns failed in March. Lehman collapsed in September. The panic peaked in October. Authorities had time to respond. They could test interventions. They could let some institutions fail and rescue others. They learned as they went. Both conditions are gone. The Fed's balance sheet is now $7 trillion or worse. Bank reserves sit at $3.2 trillion, whereas barely above the level that triggers dysfunction. Corporate debt has doubled. Pension funds are underfunded by $1.5 trillion. Insurance companies are leveraged to breaking. There is no spare capacity. Every entity is operating at maximum stress. Every balance sheet is one shock away from rupture. And the timing is no longer sequential. It is simultaneous. Let me show you how the convergence is unfolding, not as theory, as documented mechanism. I'm going to walk through each of the 9 threads we have analyzed over this series. Then I'm going to show you how they have started to braid together into a single catastrophic force. Thread 1, the dealer lockdown. Bullion dealers stopped accepting orders. Not because they wanted to, because their hedging lines broke. When you sell silver to a customer, you hedge by shorting futures. This keeps you neutral. But when volatility explodes and margins spike, the hedge becomes more expensive than the profit. Dealers went dark. They stopped answering phones. This removed liquidity from the physical market. When liquidity vanishes, prices become unstable. Small orders move the market violently. Thread 2, the auction failure. Treasury auctions started showing weak demand. The bid-to-cover ratio dropped. The tail widened. Foreign buyers, Japan, China, Saudi Arabia, are stepping back. They see the debt trajectory. They see the political dysfunction. They are diversifying away from treasuries. When auction demand weakens, yields rise. When yields rise, the cost of government borrowing increases. The deficit gets worse. More auctions are needed. The doom loop begins. Thread 3, the stablecoin threat. Stablecoins like USDT and USDC hold over $150 billion in treasury bills. They are now among the largest holders of short-term government debt. But stablecoins are fragile. If confidence breaks, if a major stablecoin loses its peg, redemptions flood in. The stablecoin has to sell treasuries to pay out dollars. This dumps $150 billion of bonds into the market. Yields spike, prices crash. Banks holding treasuries take mark-to-market losses. Thread 4, the repo surge. The Federal Reserve's reverse repo facility saw a $74.6 billion surge in a single day. This is a stress signal. When banks and money market funds park cash at the Fed instead of lending it in the market, it means they do not trust counterparties. Repo is the lubricant of finance. When it dries up, leverage breaks. Hedge funds cannot borrow. Dealers cannot finance inventory. The system seizes. The CME raised margin requirements on silver futures by 50%. This was designed to crush speculators. It failed. The price barely dipped. Why? Because the buyers are not speculators. They are industrial users and sovereign nations paying cash. But the margin hike did accomplish something else. It revealed that the paper market has lost control over the physical market. When the exchange raises the cost of betting and the price does not fall, it means the fundamentals have overwhelmed the technicals. Thread 5. The margin shock. The CME raised margin requirements on silver futures by 50%. This was designed to crush speculators. It failed. The price barely dipped. Why? Because the buyers are not speculators. They are industrial users and sovereign nations paying cash. But the margin hike did accomplish something else. It revealed that the paper market has lost control over the physical market. When the exchange raises the cost of betting and the price does not fall, it means the fundamentals have overwhelmed the technicals. Thread 6, the mortgage transmission. Overnight repo stress transmits directly to consumer borrowing costs. When repo rates spike, banks raise the rates on adjustable mortgages and home equity lines. Millions of households are seeing their monthly payments increase without warning. This is not a policy decision. It is mechanical. The stress in wholesale funding markets flows downstream to retail borrowers within days. Thread 7, the credit repricing. The software benchmark spiked to 5.43%. This repriced $660 billion in floating rate debt overnight. Credit cards, auto loans, corporate bonds, all tied to SOFR. When SOFR jumps, interest costs jump, consumers pay more, corporations pay more, the economy slows, defaults rise, credit tightens further. Another doom loop? Thread 8, the reserve burn. The Treasury General Account is draining at $12 billion per day. The government is spending down cash to avoid breaching the debt ceiling. Every dollar spent pulls reserves out of the banking system. When reserves fall below critical thresholds, banks hoard liquidity. They stop lending. Repo rates spike. Credit freezes. The TGA drain is not stimulus. It is a slow-motion bank run on the system's reserve base. Thread 9, the derivative cascade. Interest rate swaps worth $200 trillion are revaluing as rates move. A 12 basis point move in SOFR triggered $30 to $50 billion in margin calls to pension funds. Pension funds do not have that cash. They have to sell assets. They sell treasuries. This pushes yields higher. Higher yields trigger more swap losses, more margin calls, more forced selling. The derivative tail is wagging the cash market dog. Now here is where it gets dangerous. These 9 threads were always present, but they operated independently. Thread 1 did not affect Thread 5. Thread 3 did not trigger Thread 8. They were separate risks in separate domains. That separation is breaking. The convergence sequence. The TGA drain, Thread 8, pulls reserves out of banks. Banks hoard liquidity and stop lending in repo. Thread 4. Repo rates spike. Hedge funds using repo leverage get margin calls. They sell treasuries to raise cash. Treasury yields rise. Thread 2. Rising yields mark down the value of treasuries held by stablecoins. Thread 3. If a stablecoin wobbles, investors panic and redeem. The stablecoin dumps more treasuries. Yields spike higher. Higher yields trigger swap revaluations. Thread 9. Pension funds get margin calls. They sell treasuries. This accelerates Thread 2. Auction demand is already weak. Forced selling makes it worse. Yields continue climbing. Rising yields destroy bank balance sheets. Banks hold treasuries as assets. When yields rise, treasury prices fall. Banks take losses. They need more capital. They reduce lending. Repo tightens further. Thread 4. Consumer borrowing costs spike. Thread 6 and Thread 7. Households and corporations face higher debt service. Spending falls. The economy weakens. As the economy weakens, commodity demand should fall. But it does not. Why? Because the margin shock, Thread 5, and dealer lockdown, Thread 1, have removed liquidity. Prices do not follow fundamentals anymore. They follow forced buying and selling. Volatility explodes. Clearinghouses raise margins again. More liquidations. More chaos. Do you see the pattern? Each thread is now pulling on the others. The system is no longer modular. It is unified. And unified systems fail catastrophically. Let me explain why no institution can stop this convergence. Not the Federal Reserve, not the Treasury, not Congress. The Federal Reserve has 2 tools, interest rates and the balance sheet. Tool 1, interest rates. If they raise rates to fight inflation, they accelerate Thread 2, auction failures, Thread 9, derivative losses, and Thread 8, reserve scarcity gets worse as debt service costs rise. Higher rates kill the economy. Unemployment spikes, defaults cascade, banks fail. If they cut rates to save the economy, they reignite inflation. Thread 7, credit repricing, reverses, but inflation expectations explode. The dollar crashes, import costs surge, food and energy prices spike, real wages fall, social unrest rises. Tool 2, the balance sheet. If they expand the balance sheet, print money, to buy treasuries and stabilize markets, they destroy the dollar. Foreign holders of treasuries see the Fed monetizing debt. They dump bonds. This accelerates thread 2, even as the Fed tries to stop it. The Fed would be buying bonds with one hand while foreigners sell with the other. Yields could rise despite QE. This is loss of credibility. Once lost, it cannot be recovered. If they shrink the balance sheet, tighten, they drain reserves further. This accelerates thread 8. Banks face liquidity crises. Repo freezes. Thread 4. Credit market seize. The real economy collapses. Here's the trap. Both tools push the system toward failure. Raising rates kills growth. Cutting rates kills the currency. Printing money kills credibility. Tightening kills liquidity. The Fed is trapped in a box where every door leads to destruction. This is not a policy failure. It is a mathematical impossibility. You cannot print your way out of a solvency crisis without destroying the currency. You cannot tighten your way out of a liquidity crisis without destroying the economy. The contradictions are hardwired into the structure, but the convergence creates something even more dangerous than policy impotence. It creates feedback loops that are exponentially unstable. Feedback loop. Alpha, the liquidity. Death spiral banks hoard reserves, repo rates spike, hedge funds liquidate, asset prices fall, banks take losses, banks hoard more reserves. Each turn of the cycle is faster and more severe than the last. The first cycle takes a week, the second takes 3 days, the third takes hours. Feedback loop beta, the debt growth collapse. Rising rates, higher debt service, lower corporate profits, credit downgrades, higher borrowing costs, even lower profits. The economy enters a vicious cycle where debt service consumes all available cash flow. Investment stops, hiring stops, growth stops. Feedback loop, gamma, the confidence cascade. Weak auction, yields rise, foreign buyers exit. Weaker auction, higher yields, more exits. Once foreign confidence breaks, it does not return. The selling feeds on itself. The treasury market, the deepest and most liquid market on earth, becomes unstable. These feedback loops are not linear. They are nonlinear and chaotic. Small shocks produce massive effects. A 10 basis point move in yields can trigger a 20% drop in bond prices if forced selling accelerates. A 1% decline in reserves can freeze the entire repo market if trust evaporates. The system is now operating in a region of instability where normal rules do not apply. And here's the most terrifying part. There is no historical precedent for this convergence. In 1929, we did not have $200 trillion in derivatives. In 1987, we did not have algorithmic trading. In 2008, we did not have stablecoins or a Fed balance sheet at $7 trillion. We are in uncharted territory. The models do not work. The playbooks are obsolete. The authorities are improvising. Let me bring this down from the systemic level to your kitchen table, because when 9 mechanisms converge, the impact shows up in your bank account, your monthly bills, your job security, and your retirement balance. Your monthly costs are rising from multiple directions simultaneously. Your mortgage resets higher because repo stress moved softer. Your credit card APR climbs because the same SOFR spike repriced your balance. Your insurance premium jumps because insurers are bleeding from bond losses. Your grocery bill increases because the Fed might print money to stop the cascade. You are being hit from every angle at once. Your retirement account is hemorrhaging value. Pension funds are liquidating to meet derivative margin calls. Your 401k is down 12% in 3 weeks. You did nothing wrong. You saved every month. You diversified. But the convergence does not care about diversification. When everything sells at once, correlation goes to 1. Stocks fall, bonds fall, nothing is safe. Your job is at risk. Corporations cannot roll their commercial paper because credit markets are seizing. Your employer announces a hiring freeze, then layoffs. Even if you survive, your raise is canceled. Your bonus is cut. The 401k match disappears. The wealth transfer from labor to capital accelerates. Your savings are trapped. If you hold cash, inflation destroys it. If you hold bonds, yields are rising and prices are falling. If you hold stocks, forced liquidations are crashing the market. If you try to buy physical assets like silver, dealers are not selling. There is nowhere to hide. Your access to credit is vanishing. Banks are hoarding liquidity. They are raising standards. They are denying loans. If you need a car loan, a mortgage, a business line of credit, the answer is no. The credit window is closing. Only the strongest borrowers with perfect credit can access funds. Everyone else is locked out. This is the wealth transfer mechanism of a convergence event. The system does not distribute losses fairly. It concentrates losses on those least able to bear them. The pension funds and banks that created the crisis get bailed out. You absorb the cost through higher prices, lower wages, lost savings, and reduced opportunity. The convergence is not just a financial event. It is a social and economic restructuring that happens without a vote, without transparency, and without mercy. We have spent this series analyzing 9 invisible mechanisms. Each one was dangerous alone, but alone they could be managed. Regulators could isolate them, markets could absorb them, time could heal them. But now they have converged, and convergence changes everything. The system is no longer stable, it is balanced on a knife edge. Any shock, any misstep, any unexpected event can push it over. So how do you know when the convergence has reached the terminal phase? How do you know when the system has crossed the point of no return? There are 3 signals. Watch for them. They will not come with warnings. They will not be announced in advance. They will simply appear. And when they do, you will have hours, not days, to act. Signal 1. A money market fund breaks the buck. Money market funds are supposed to be safe. They hold short-term debt. They trade at $1 per share, always. But if a corporate default happens, if a repo counterparty fails, the fund takes a loss. The NAV drops below $1. When this happens, panic spreads instantly. Every investor in every money market fund rushes to redeem. Trillions of dollars flee the system overnight. The short-term funding market collapses. Credit freezes. This is how the 2008 panic accelerated. If you see this headline, you have 48 hours before markets halt. Signal 2. A major. Clearinghouse declares a member default. Clearinghouses guarantee every trade. They are the bedrock of market stability. If a member, a bank, a hedge fund, a dealer fails to meet a margin call, the clearinghouse has to step in. They tap the default fund. This is the red line. It means a systemically important entity is insolvent. If CME Group or LCH announces a default, trust evaporates. No one will trade. Liquidity vanishes. Exchanges halt. This is the Lehman moment. Markets do not reopen normally after this signal. Signal 3. The Fed holds an unscheduled after-hours announcement. Central banks operate on schedules. FOMC meetings are planned months in advance. Press conferences follow a calendar. If the Federal Reserve calls an emergency press conference on a Sunday night or after markets close, it means they have lost control. They are in crisis mode. The language will be calm. They will talk about supporting market function and temporary facilities. Ignore the words. The timing tells you everything. When central banks act outside normal hours, the system is in free fall. If you see one signal, prepare. Move to safety. Check your positions. Review your liquidity. If you see 2 signals, act immediately. Reduce risk, increase cash on hand, secure essentials. If you see all 3 signals, the convergence is complete. The system has entered the terminal phase. At that point, the cascade is unstoppable. This has been a journey through 9 invisible mechanisms. We started with dealers locking orders because their hedges broke. We analyzed treasury auctions failing as foreign buyers stepped back. We exposed the stablecoin threat to the reserve base. We revealed the Fed's emergency repo interventions. We dissected the margin shock that failed to crash the market. We traced the transmission from wholesale funding to your mortgage payment. We mapped the credit repricing that hit $660 billion in debt. We uncovered the Treasury cash burn draining reserves. We documented the derivative margin calls cascading through pensions. 9 mechanisms, 9 threads, each invisible, each dismissed as noise, as conspiracy, as fear-mongering. But together, they form the anatomy of a systemic failure. They show the pathway of the cascade. They prove that the convergence is not a theory or a prediction. It is a process, a mechanical, measurable, inevitable process. The question is no longer whether the system breaks. The question is what you do when it does. Do you hold paper promises while counterparties fail? Do you hold assets being liquidated by forced sellers? Do you trust institutions that are trapped in impossible choices? Or do you hold the things that exist outside the system? The physical assets with no counterparty risk, the land that produces food, the metals that store value across millennia, the skills that remain valuable when complex systems collapse. The convergence is here. The threads have braided into a rope, and the rope is pulling tight around the neck of the financial system. The authorities know it, the insiders know it, the market is starting to know it. Now you know it too. Stay informed. Stay prepared. And remember, in a convergence, survival belongs to those who saw it coming before it became obvious.